All right, welcome back to Street Smart. I'm Adam Johnson, and our guest now, we've been talking about him for several days, Tom DeMark. He is founder of the DeMark's Studies, one of the most widely followed market timers in the country, advises all the big guys on the street. He successfully called the April top as well as the October low to the day and almost to the point. Tom, thanks for joining us.
It's great to be here again.
All right, Tom, you about 2 weeks ago came on our air and said you need to buy the S&P 500. It's going higher, 1313 to 1340. You also thought it was going to happen by 1221 yesterday. It didn't happen. What do you think about the S&P right now?
Well, I'll tell you, Adam, Edgar Fielder, the economist, said if you're going to make forecasts and you want to be correct, make sure you make a lot of them. That hasn't been my attitude, and that's not the way I operate in forecasting the markets. But it's difficult. It's difficult to define when a particular top or bottom is going to occur unless you use a model. And the model we use has not spoken, unfortunately, but it still is directing us to the upside. We're currently at the same price level we were on the December 5th day, and the market still looks like it go higher. Unfortunately, on May 2nd, when we called the high, it was the day of the high. The same with August 9th on the day of the low, and October 4th, the day of the low. And then on October 27th, we fulfilled our upside price objective, 1254 to 1257. That was the day of the high. So it's, if someone were perfect, obviously the business would be no fun. So we're operating right now.
Yeah, I hear you. And by the way, if I recall, you were trying to extrapolate. You had said that the previous 3 upward moves in the S&P were 17 to 21 days, and based upon your model, you thought that December 21st would be the peak. You're extrapolating. Is that right?
That's right. I mean, just for simplicity's sake, I said the rally off the August 9th low was 16 trading days. The rally off the October 9th low was 17 trading days. So just for simplicity's sake, I said this one will probably be 17 days. That was December 21st. Actually, you've got the seasonal pull through the first week in January. You've got a lot of other factors that are dictating the market should go higher, and it has. Usually when a market makes a top like it did back that first week in December and it does correct less than 5.56% and rallies again, typically that peak is taken out. And our models are still telling us that the upside is the direction to follow the market.
Now, you also sent me a chart that I found pretty fascinating. You overlaid where the market is right now with the sell-off and then what happened back in 1988. In other words, a roadmap for the fact that we've seen this play out before. Right now, there it is. The yellow line is the current is back in 88. The white line is where we are today. Talk us through that chart and why it's relevant.
Well, it just struck me. The market had a decline from the August high in 1987, and it collapsed to the October 19th low in 1987, then struggled for a period of time, and then rallied. It looks somewhat akin to what the market has done recently. Obviously, I'm taking out of context the high on May 2nd that we had this year. We had 3 particular time periods all coinciding and indicating a decline, whereas in 1987 there was just one time period, the daily, and the market recovered. So we got something a little bit different, but it's something to look at. I mean, the market, some people could argue that the market is going to rally from here and continue rallying. The market's been buffeted by a lot of negative news. The European markets, for example, stock markets have made their lows in September, have gone up October and November and currently, and the news gets progressively more negative. So the markets have withstood a lot of pressure.
You've also made the comment to me that we got to get through the high from October 27th, I believe it was 1284, and then you're looking for 4 to 5 successively higher closes. Is that still part of your thinking?
Still active. What I'm looking for, and I think there was some confusion the prior 2 times I was on the air, the October 27th high day's close is very critical. And once we exceed that October 27th, if we do, that October 27th high day's close, we must record 3 successively higher closes. And that will fulfill the requirement of our model to identify the market top. It's the same model we use for the August 9th low and the October 4th low. It might possibly be 4 closes, but we're running against the beat the clock right now. I think we've got maybe 8 more days. The VIX, or the VXO, is what we really concentrate upon. It's getting very close to a bottom. It could 2 more lower closes. That index, that volatility index, could identify a bottom, and typically anywhere from 2 to 7 days later, markets top. So we're running into by the end of the first week in January, we should have accomplished what I'm looking for, which is 3 successively higher closes over that October 27th close.
That sounds good. I want to keep it moving. We got a lot to talk about. You've applied your indicators to the jobless claims number. What's the quick takeaway there?
Well, I'll tell you, it doesn't look good. We've applied our models, which are called sequential and combo, for primarily the markets, but they also have application to economic indicators as well as politics, and you'll see that shortly. If you apply that jobless indicator model to the jobless indicator, you can see in 2006 there was a low made, and subsequently the jobless claims went up to a peak in 2009, and the market bottomed. And currently we're at a low again. So that doesn't bode well for the market.
Yeah, that's reason to be cautious. So that might explain why you like the S&P maybe for another couple of weeks, and then your up move will have been fulfilled. Moving on, let's talk about the euro and the dollar. You're positive on the euro. You got a buy signal. The flip side is, of course, that means the dollar's going down. Talk us through each of those.
Well, we called the high on the euro some months ago, almost to the day, and now we've identified the low and was to the day last week. And conversely, the dollar has operated inversely, and they're both moving now in the direction in which we anticipated. But they've got to move more quickly to really continue these trends that they've established as of last week. But we are getting some relief in the stock market as a result of those two turns in these two currency markets. So we're somewhat sanguine about both, and we'll see how it develops. We got another week or seven to 10 more days in both markets before we might express some concern.
All right, something novel that's going to fascinate a lot of people. You've applied your indicators to some of the political goings-on around town. Why don't you talk to us about applying these things to the Gingrich approval ratings?
Well, I'll tell you, that was a surprise to us. When we applied our indicators to economic models back in the 90s, we were surprised to see that they had, because everything in life is dictated by human nature, and trends are established because, and they move to extremes with fear and greed. And we see the same thing. We applied it in 2004 to the intrade.com site, which has betting on political fortunes of politicians and who are participating in the election.
Tom, recently you called the top on Gingrich. We're showing the chart right now.
We called the Gingrich top, and we called the Romney bottom. And right now, it was right to the day, in fact, where the 13s appeared. We're really as surprised as most people are that the indicators do have some validation when they're applied to trends such as the popularity of a politician.
Yeah, pretty amazing stuff. Tom DeMark, always fascinating talking to you. We appreciate your coming on, defending the S&P call. Great to have you on, Tom DeMark.
Well, thank you very much for having me.